Hello, one and all. Welcome to the webinar. I'm going to share my screen. So welcome to today's webinar. This is the second of a 4-day live trade execution series subtitled How to Capitalize on Monster Moves in the Markets. My name is Mark Shawson, the pattern trader. There was a question from Accentra saying I did not get a recording. If you want a recording, go ahead and message our support team. You should get one, but our support team will help you out. So I'm going to put the link in the, let me just make sure I got it right, in the chat box, and just message them if you want a recording of yesterday's session. So yesterday we talked about how to use price action and price patterns to capitalize on the markets. And I touched on the subject of risk management. I'm going to try and just find a an example of a trade and how to use risk management on a trade. So here was an email that went out a week or so ago to put a buy stop in the Australian dollar at a price of 74.51 with a stop loss way below here at 73.17. So I like to kind of give the market room. Perhaps I left it too much room. So what is that? 134 pips stop loss. And people usually say, well, I can't normally use that big a stop loss. I get wiped out. And yes, if you would use your current position size, you would get wiped out. But you can see I put a trade risk profile of 1% on this trade. And now I'm going to show you how to actually set up that trade using proper risk management. So this is a position size calculator. I'm going to put this in the chat box so you don't have to furiously scribble it down. And this is exactly what it says it is. It's a position. It tells you exactly how big a position you should have for a given level of risk. And so basically you use this to scroll down to find your pair. In this case, the Australian dollar. Where is this thing? Australian dollar, US dollar. And then you can use this calculator in every major currency around the world. I'm going to assume a US dollar account. Let's just assume a relatively small size account, $2,500. And here's your risk ratio, 1%. I'm going to show you how to dynamically change all this thing. And remember, our risk was 137 pips. So this is actually 1%. This is what you're going to risk of your account. It doesn't matter how big your stop loss is. And so then you now this is one lot equals 100,000 units. So you should be using a tenth of one lot, which is 0.1, which is like a mini lot. And then you hit the calculator button, and this basically, so they changed this thing. One lot equals 100,000 units, so 0.1 should equal 10,000. And so they changed this on me, and I don't know, they made it a lot more complicated than it used to be. And now I don't know if I'm using the right, this does not look like the right calculation. So one lot equals 100,000 units. So 0.10 should equal 10,000 units, but that's not what this is indicating. Sorry about this. They changed this up. They made it much more complicated. It used to be such a great site. And now IG just changed the limit size, so they won't give you. Yeah, so this is an IG. This is my FX book. So I'm not quite sure if they won't now So I'm not sure if 0.18 is the right size for this. So I guess it would be 0.18 lots. You would risk $25. Wait a minute, 1% of 2,500 is $25. So that basically, let me just dynamically change this real quick and see if this, so if I use 0.5, that's 0.5%. Yeah, so this is correct. All right, so this is how you use this risk calculator. So one lot equals a normal size unit, which is 100,000 units. Now, most people have got a small account, so you're going to need to use a mini lot, which is a 10,000 units. So it's 1/10 of one lot. So it's expressed as 0.1. And so I typically recommend that you use 0.5% risk on your trade size. And this way you can't be wiped out. If you take a 0.5% risk, if you take 10 trades in a row and you lose all of them, you're going to lose 5% of your account on 10 trades. So pretty hard to lose 10 trades in a row. But even if you do, you're only going to risk 5% of your account. So you can see you can play around with this thing. So if you want a smaller lots, I typically, risk about 60 to 70 pips on a trade. So in this case, you can put 0.19 mini lots, on a $2,500 account, risking 67 pips on Australian dollar, US dollar. So this is how to kind of dynamically use this risk calculator. But this is imperative on coming up with the size calculations on your trades. And so let me just go through something else like, we talked about a pound New Zealand yesterday. So I just want to kind of, here you come down to pound New Zealand, you have a 20, let's say you want to take a 0.5% risk, you want to take 147 pip. You have to give some of these trades bigger, wider margins to swing. So you hit the calculate button. This tells you can do 0.12 mini lots, and you would only risk $12.50 even if you hit 147 pip stop loss. So this is really critical. I am looking for the bigger moves in the market. So in order to extract the bigger moves in the market, I don't risk. So let me just kind of play around with some images here. So most people are trading, we went through this yesterday, they're looking for 10, 15 pips in the market. And if you're looking for 10 pips and you're looking to risk 10 pips, you have a 1-to-1 risk reward relationship. And so, for every time you win, you're also losing, and you have to win 90% of your trades in order to be effective if you have a 1-to-1 risk. Whereas what I like to do is set up trades where I have a 3-to-1 risk reward relationship. Where if I'm looking to get in something, if I'm looking to get in a Forex trade, I don't look for anything less than 150 pips. Now, that sounds crazy to a lot of people. People, have told me that before they met me, they've never made 100 pips on a trade. I don't get in a trade unless I can see a clear path to making 150 pips. And in order to make 150 pips, I'm willing to risk 50 pips. So now I have a 3-to-1 risk reward relationship. Very different than a 1-to-1. So what's happening is that people are trading too short term. They're using 15-minute charts to get in and out of the market 10 times a day and try and extract, 7 pips here and 7 pips there. That's just not going to work over the long term. And that's not my opinion. Just look at the statistics in the FX business. It's estimated that 90% of people lose their money. I think it's probably more, 95%, because people are not setting up their trades with the proper expectancy. So I'm looking for 150 pips on a trade, sometimes 300, sometimes 500. I've taken 800. I've taken 1,200 pips out on trades. And so if you have a bigger outcome on your trades, you can actually, so this means that you have to be more selective because there's not that many trades that are going to give you 150 pips. So you're not trading as much, but you also can lose a lot more of your trades. So you can actually lose 72% of your trades if you have a 3-to-1 risk reward relationship. Does that everybody kind of understand? So this is very important. This risk management, how to set up your trades, how to manage risk. So I typically say you should only risk 0.5% of your trades. You can always build a position. You can always leg into a position. But if you're starting, if I feel really good about something, I'll use it. I'll start with 2% of my account. But if you lose a lot of trades, if you lose 10%, 10 trades using 2% risk, you can lose 20% of your account very quickly. Whereas if you keep your risk low, very difficult to blow yourself out. So Marcus says, very important. Now I understand it. So risk management is critical. This is a very overlooked component of trading, very not talked about component of trading. And so, now you can, people always, get intimidated when I show them, the big moves that I've made in the market. Let me kind of come to this. So these are the trades. This is what my trades look like every day when I send them out on my email. Sorry. I'm trying to just find something here. Let me just find something really quick, and I should have had this open. I apologize. So this was an extract of some trades that I did a while ago in the dollar versus the Japanese yen. Let me just blow this up a little bit. And whenever I show, how I'm in, a trade that I sat in for a long time, there seems to be a misperception that you have to have a big account in order to do that. So this was the email that I sent out on a Sunday. I think it was the 23rd. It was April 23rd on a Sunday to sell the dollar yen at 111.61 on a sell stop. I got triggered and I ended up hitting a take profit 650 pips lower 3.5 months later. So I got in on a Wednesday and got out at April 25th, and I got out in August. I sat in this trade for 3.5 months, but I took 650 pips out of this trade and made $312,000 on that one trade. Now I added to it, and I'm going to show you this chart. And the thing is, when I show how I extract these big trades, people have this misconception that they need to have a big account in order to take advantage of that kind of trade. So that is what I'm really looking for in my trades. I'm looking for big moves. So this was it right here. This is the dollar yen. And I was noticing that the dollar yen was in this cadence of this descending triangle. And right here, we hit this area where you hit a double top right at this resistance line. And there was this bar right here, this very narrow range bar. Now, this is a weekly chart, and you can see this was the range from high to low of that 1 week. It was a compression, a narrow range bar, an inside bar, whatever you want to call it. But to me, what this represented was that the market started stalling out right at the top of this range, right in this resistance level. And I surmised that the market was going to stall out right here and go the other way. So what I did was I sent out an email on a Sunday to put a sell stop right there at 111.61, right under the low of that little small inside week bar. And what happened after I sent the email out on a Sunday was that, I'm trying to find a color that's, the market opened and went higher. And if the market had continued going higher, that resting order would never have been triggered and no harm, no foul. But what happened was, after I put in the order on a Sunday, the market went up for 3 days. And then on Wednesday, while I was sleeping in the middle of the night, whatever, I was triggered into this trade at 111.61, and I was put into a 650 pip trade. So I think my risk was about 70 pips on this trade, where basically my stop loss was above this high. And so I got triggered into trade at 111.61. I had a stop loss about 70 pips higher, and I ended up making 650 pips. So that was about, an 8-to-1 risk reward ratio, meaning that I risked 70 pips and I made 650 pips, almost 10-to-1 risk reward. Now, you don't always find these trades. It takes a long time. And I also had to sit in this trade for 3.5 months. I had to sit for 7 or 8 weeks while this thing went sideways or against me. So sometimes these things are not easy to do, but this is how you make the big money on trading, by capturing and capitalizing on these bigger moves. And unless you do so, it's unlikely you're going to be successful. If you're trying to be in and out, darting 7 times, 10 times a day, trying to take 7 pips out of the market, it's very unlikely that you're going to be successful. So Prana says, where did you put your take profit? So I put my take profit right in this support area. So right at this area, I told our members, we're going to come right back to this support level. Because once you see a descending triangle, the price action in a triangle typically looks like this, where you bounce and you hit this level many, many times. And so you can see this hit it twice. It, hit it about there. So when it was up here, I surmised it was going to come back there. And when it bounced up here, I shorted again and surmised it was going to come back here and here and here. That's how a descending triangle behaves. So, it sounds like magic, but I was saying right at when I was shorting this thing that my objective are these lows right here. And that was about the 105 area. So you can see that I put my take profit just a hair above 105 to make sure that I got in there. I got out at 105.17. The market went to about 104.50. And so I try and get a piece of the middle. And in this case, I got the whole trade. I got the whole thing. Sometimes, I understand the pattern. I understand the pattern that the market's in, and I can visualize the upside and, the downside and exactly where the targets are. So my take profit in this case was right at these lows. And when it got to a double top here, I shorted it and my take profit was right at these lows. So, but what I'm trying to do is show you how I was able to risk 70 pips on a Japanese yen trade and then add to my trades. I added several times on this key reversal, on this key reversal, and made a ton of money on this thing as it came down. But, I was risking 70 pips on that trade. So most people are risking whatever, 7 pips or 15 pips or 20 pips, so I'm not, looking to play those games. I'm looking for these kind of moves in the market. And so basically come here, dollar, where's dollar yen? Put your stop loss at 70 pips. You want to risk a little bit more. Maybe you want to take a percentage and a half, hit the calculate button. You can do 0.6 lots, risk $37.50. If you get stopped out, oh well, you lose $37 of your $2,500 and you live to fight another day. Sam says, it seems you hold on to FX positions longer than equities. No, that's not true. It really depends on the environment. So, I'm always looking for, the bigger moves in the market, but they don't always occur. So right now in the stock market, it's fairly whippy, but I'm taking a position in this small little stock with the view that I'm going to hold on it for a little longer. It came off today. I actually started buying more into the sell-off, this ME. I think I shared it with you yesterday. And I actually, bought some more in here. And I'm looking, to hold this for a longer term view. So every trade is different based on the dynamics of the trade. So I don't have any viewpoint. I try and look at what the market is giving me at the time. Sometimes I'm going to trade shorter because that's all the market's going to offer me at the time. Sometimes, there's a setup for a much bigger move, and, I will, take advantage of that. So, my trade setups, my trade horizons, the time I'm in a trade, will vary based on the environment, based on what is given to you. So now we're at, a very, we've had a huge move in the stock market. The smart stock market has been going up straight for a year. And now, it's likely that you're going to go into some kind of consolidation, some backing and filling, what have you. And so, the huge moves that I, used to anticipate, you got to be a little bit more realistic now. But for instance, I am, taking a long view. Now, the market may dissuade me of that. Right now, this is, a stock with very little history. But really what I'm looking at is very simply a pattern that informs me that this thing has bottomed. So if something has bottomed, it should find its way higher. Now, we also have, hit a formidable resistance level. And right now we're looking at this, huge key reversal. Now it's only Tuesday, so, let's see where this closes by the end of the week. This is a weekly bar, and we'll see where this closes. It hit a natural inflection point, bounced off, and I'm actually just buying more on the premise that if this thing's bottomed, it's going to find its way higher. There was a stock that looked a lot like this that I played, and you can have the same characteristics where it looked like nothing. This is a firm, and you can see that this had kind of the same look before it took off, and then it did that. So, we'll see. So I, basically look for the market to inform me of, some kind of telltale pattern to kind of get me on the right side. And there's really no price action right now to inform me where to get in. Usually, like I said, I use my insurance day bars, my key reversal inside day bar. There's nothing really like that. So I'm looking at this pattern here, which tells me that this looks like it's bottomed, but this could also be a top, and, we could also look like that. I'm going to look for the market to kind of collect itself, maybe do an inside bar, start, kind of looking like maybe it's doing something. So this is not the best example of, a great trade. I think that, this is going to work out, but I don't really know. This is a bad looking sell-off right here. So, I'm going to kind of gauge what happens, and, we'll see. But, this seems to be a bit of an area of support here. And, I'm just looking at this. If this starts piecing itself together, I'll get aboard that trade. So it's all based on, the price action in the market. One of the markets that I told you about yesterday was Teladoc. I believe we talked about this trade where I think this is where my computer cut off. So again, it all starts with a picture, and you should have received a kind of a booklet with basic patterns. And so again, armed with the knowledge of just a few trading patterns, that's all you need to make a fortune of money in the market. So here is a head and shoulders. So this looks just like a man or woman's left shoulder. The peak is the head. That's the right shoulder. And so this is a bearish price pattern. This indicates that the market leading up to this pattern was going up. And this is a reversal pattern indicating that the market should trade lower. So now, you see these patterns in the textbook, you see these patterns in the market, and then I look for verification that these patterns are going in the direction that it's indicated. So you can see that basically the neckline was around here, connected the first head and shoulders. Then we had a, neck secondary. So you've got these various levels of support, but this is now what I look at. We made a new high, close at the low last week. And so you can see made a new high, close at the low, and it puts you in, the market actually points in the direction it wants to go to. So now I'm surmising that Teladoc is going to kick back in the direction, of its trend, of its pattern from the key reversal. And I sent out an email last night to our elite members. Let me see if I can find it. Just want to take out my personal email in here. So this is what my daily emails look like. So yesterday I said put a sell stop in Teladoc at 145.75. The nice thing about this is that you had a very small risk for a big reward. I said Teladoc recently broke above a descending triangle price pattern. I think the breakout is a fake out. Penetration below the low of the recent key reversal and yesterday's inside day bar could be followed by a healthy move to the downside. I like the risk reward on this trade. The reason why I like the risk reward on this trade is because, sorry, let me just get out of this. So we see that big head and shoulders on the weekly, and then on the daily, you've kind of been traversing within the confines of this descending triangle price pattern. Now, sometimes the market breaks out, gives you a little head fake, breaks above this, an area, everybody gets excited, chases it, and then it works out into what's called a bull trap, where all the bulls, who chase this get trapped, and it goes the other way. And so you got to keep an eye on what is the major trend, in this pair, even though, the market sometimes goes in these, in these waves where the market goes higher, but you got to be aware that this is a major downtrend. So yes, you do get these head fakes. The market always gives you some distraction, but if you know the direction that you should be faced, then you look for this made a new high, close on the low. So you can see that's what I call my insurance day bar. Whenever I see these, in the direction, this tells me how to hop aboard a trade and where my risk is. So in this particular thing, I would basically put a sell stop right underneath the low here. I put my stop loss here. That would be my risk. And I would look for a much bigger reward on this trade. Now, once this thing got going yesterday, there was this little itty bitty narrow range bar. You can see how small that range is. And what I like about these, narrow range is that it tells me that, my risk is very small. So that I said, basically put in a sell stop at 145.75, put your stop loss right there. So you have like a $2-3 risk for what could be a $20 move to the upside. So you can see this is already I said risk $3 and you're already $3 in profit. So you've made 100% on whatever you risked on this trade if you went short. And now once we kind of enter this geography of this triangle again, it's very likely we're going to see something like that. But what I did was I just used the setup, I used the trends, the direction, the reversal, and then I waited for a particular opportunity where this inside bar, this narrow range bar said, okay, this is how I joined the trade. I basically put a stop loss underneath here. I'm sorry, a sell stop there. I put my stop loss just above the high. So I've got a very small risk for a very big upside. And that, ladies and gentlemen, is just how how you make a lot of money in the market. So if you can identify certain periods of time where the risk is very small and the reward is very big, that's how you make a ton of money in the market. So you can see right here, there was a juncture where you hit this double top, and then you had this, narrow range bar, this inside bar here. And then, you get short underneath that, it gives you, a huge move. So what I do is I look at, I think I put it out yesterday, the phase or the direction or the trend. And in this case, the trend is lower. Then I look to see if there's a predictable chart pattern. And we saw the head and shoulders on the weekly, and now you see this descending triangle. And then, I wait for a time where I see my insurance day bar. We talked about this yesterday. And to me, an insurance day bar takes the form of two things. One is a key reversal. Sorry about this terrible writing. And a key reversal, remember, is basically an observation of how something closes relative to the high and low. So if we close there, I think we can all agree that this closed closer to the low than the high. That by the end of the day, the sellers were in control. And you can see right up here, this is the start of it. Made a new high, closed on the low, and that was the beginning of a beautiful trade. So I don't trade, key reversals just in a vacuum. Every time I see a reversal, that points higher, I get, so you can see here's a, reversal, but there was no follow through because this is a downtrend. So I don't just buy something like this because I see a reversal. It has to be in context with the trend and the pattern. Then the other condition for an insurance day bar is an inside bar, or what I call a narrow range bar, where literally you can see the high and low of that day sits within the high and low. Let me see if I can find a better example. This is a pretty, so you can see right there is a narrow range bar. You can see that this bar right here, the high and low of that bar sits within the high and low of the previous. So all you have to do is put a sell stop underneath there and you're put into a nice trade. And so, I layered this 4-step execution plan with an execution that requires me to put a buy stop above a market I want to buy and a sell stop below a market I want to sell. So I basically last night sent out an email saying put a sell stop right there, 145.75, and now you're into this trade and you're up $3-4 already. And now you just manage the trade. We see where it goes and what have you. So I basically just put a sell stop right underneath there to catch that trade. Does everyone understand that? So Daniel says, do you look for the key reversal bar and the inside bar in the weekly or the daily? It doesn't matter. So right now I'm looking at a daily chart. So I'm looking at, the patterns on the daily, but you use the same analysis on a weekly or a monthly. It doesn't matter. it all works on these different time frames. If we go to the weekly chart of Teladoc, do the same, use the same bag of tricks. So you use your pattern. So here's the key reversal. Basically, you'd put a sell stop right underneath there. Put your stop loss somewhere out of the way and let this thing go to work. You can see there was a bit of a key reversal here a couple of weeks ago. And when I see these right at the low, it kind of indicated that there was going to be some support here. So again, you can't just look at these in vacuums, but when they appear at certain points, they have certain implications. So Carl says, how do you define a key reversal? It's basically a market that goes one way and then closes at the other direction. So in this case, the market made a new high, closed at the low. Now you have to look at this in context with the trend or the pattern. You can't just fire at these. Now you also have the opposite, makes a new low and closes on the high. So you can see like this guy right here, made a new low, closed at the high, and kind of pointed in the direction that this market wanted to take. Made a new low, closed at the high, and created a support level. So I look at, a combination, but, it all starts off with what is really occurring here? What is happening? So this is effectively a downtrend. And then there's a chart pattern that indicates that this is really a very bearish formation. Now, the thing is, even though we see these things, the market can go sideways for a long time before it breaks in the direction. Peloton broke $50 last week, but I've been saying since February that Peloton was going to be a $40 stock and that Zoom was going to get cut in half. So you can see this is Peloton, this bike thing that, made a lot of money during the pandemic. But at one point, you saw this very bearish head and shoulders price pattern. And when I saw this back in February, whenever this was, April, 6 months ago, I said, this thing's over. This thing is going to be a $40 stock. But you can see that the market is like a magician. It shows what it wants to do, but then it kind of does, all kinds of distractions to get the weak hands out. So you had a head and shoulders, and then you had this rounding top, and it was all connected by this common neckline. And so once it kind of shattered this area, $90, then this is what was in store. And so once you understand the pattern, you can see the key reversal here, made a new high, close on the low. Then you had all of these inside bars right there. You had an inside bar right there. You had a key reversal right here. And all you have to do is stick your stop loss under that, and you put into that trade. So this is a weekly chart, so you can, use the dynamics of a weekly or a daily or a monthly or what have you. So are there any questions on that? Let's see. Benson says, how do you handle a market that shows a weekly uptrend with a chart pattern but shows a doubt? So, this is the conflicts that we run into as traders, is that you can get, two patterns. So here's a great example of that. Good question, Benson. And this will, I think, answer your question. So sometimes you get into a little bit of a war, a tug of war, where you see two patterns fighting with each other. And now you got to determine which one is the governing pattern. So this is the Chinese stock JD.com, ticker symbol JD, but it really doesn't matter. This is an illustration of exactly that question. And this is what the conflicts we get into. Market throws us all kinds of looks all the time. So here is a double top head and shoulders right here. So this was your chart pattern that said this thing was going to go lower. And that chart pattern did its work. It dropped from 100 all the way to 60. So if you just observed this, you could have made, a lot of money on that. But then the market kind of came along and showed you this double bottom. Now, when it, kind of came back here, I bought this thing, and I was kind of on the fence whether which one was going to rule. Is it still, this head and shoulders, or now, do we have a bottoming behavior where, eventually this U-boat's going to turn around? And so basically the answer to that is, I let the market answer that question. So to me, the market is always right, and I let the market tell me. So at this juncture, I was kind of looking at this thing and thinking, is this an inverted head and shoulders, an upside down head and shoulders? And basically you had the neckline, and so you had the breakout, and it looked all good. So now this looked like a bottoming thing, but then right here, you saw this guy appear, made a new high, close on the low, the vaunted and the dreaded key reversal. So now, if you were on my email list, I got in somewhere in here on this move, anticipating that we would break higher. And I put a limit on this thing at 87.77 to get out, a take profit. And it went to 87.83. My limit was within 6 cents of the high. Now, there was a bit of luck, a little bit of fortune, but the reason why I put a take profit there was that I saw this guy right over there. So sometimes, there will be a bar all the way in the past history that will tell you where something's going to stop or where there's a resistance level. But whatever it is, now this thing, I was open to maybe this thing turning around, but then the price action is like disavowed me of that notion. And I think that we're just going to kick back into the trend that was indicated by that head and shoulders. So now, more recently in JD, you've got this double top. You kind of cleared this neckline. You had these, and it was really these guys right here. It was how a market tops, made a new high, close on the low, made a new high, close on the low. And so I think you're just going to kick back into the trend indicated by this. But you can see that there is patterns that come out of the blue that we can make a good amount of money going the other way. So this is what I call a counter trend trade, where the main trend is lower, but you can see, from this thing went from 60 to 85. And I will take those trades. If a market's going to go up $20 and I can see a good pattern and a way to take advantage of that, I will do it. But now, I would take this the other way. So that is an indication of how the market throws you different looks. You got to figure out which one is the governing pattern. And, take some experience, and, ultimately the market tells you which way it wants to go. So you can see that this is the weekly chart, and it's a little bit confusing because, this looked like a very solid bottoming thing. That was the double bottom on the weekly and the daily, and you had a nice move. And now it's kind of kicking back into this very ambiguous kind of area here. So now it's, a little bit more difficult. So, here was your kind of head and shoulders, gave you a good move. And now, it's a little bit more ambiguous. But I do think that, the path of least resistance is lower. But that was an example of how the market kind of gives you two looks, and you know, you got to sort things out. So Mark says, would the pattern with the larger bars be the dominant one? Not really. Not really. There are no rules. There are no rules. You just have to me, and here's the thing, if you can kind of understand this thing, it took me about 4 decades to understand this, is that let the market tell you how it wants to go. So I used to, you know, look at the textbooks and see, you know, a textbook, you know, Head and Shoulders, and you see this and it goes. But, you know, sometimes you see a Head and Shoulders and then it breaks out a little bit and then it starts doing, you know, it can do that. You know, so to my mind, you know, I try and observe when I see something, my anticipation is that this is what should ensue. But if, you know, we kind of come under here and get a little trapped and start going the other way, then you can get what's called a busted pattern. And that, you know, the implication of that starts getting busted as this goes the other way. So it took me a long time to kind of, what I do is I put a structure, a boundary around prices, and then I observe how prices go. So in this, you know, area here, I was looking at this thing and thinking, man, this could be a double bottom, inverted Head and Shoulders. We could be, you know, breaking out and doing a U-turn. But then I saw this guy, and, you know, right at this area, and, you know, and then you kind of see that the market, you know, follows through very quickly. And, you know, if this was, you know, sometimes you do get breakouts. You get a breakout, you get a retest, and then you get a follow through. But you can see that the market just started leaking, that there was no, you know, indication from the market that this now had, you know, is a turnaround. So it's kind of setting a structure around prices and then seeing how the prices react to that structure. And if you can kind of get the nuance of that, it took me about 40 years to figure that out. Daniel says, when you are going to trade based on the inside bar, do you place your order above or below the inside bar or below the bigger previous bar? How about the stop loss? So yeah, you just put it, you know, put your, you know, buy stop or sell stop above the inside bar. So I'm trying to find an example of that. This is kind of such a higgledy-piggledy chart. I'm trying to find, you know, so in this case, you have a key reversal here, and I would basically just, you know, put a sell stop underneath here, put your stop loss there, and, you know, take this short. I'm trying to think of a better chart where maybe we'll see an inside bar to answer that question. So sometimes you get a combination of an inside bar. Trying to. So, you know, here's something on the way up where basically you broke out of an ascending triangle and you start a breakout. So now you're looking at this thing saying, okay, it's a breakout. This thing looks like it's going to go higher. I want to get long. Here's my key reversal. And so you put your buy stop there and it doesn't get triggered because the next day you have this inside bar where literally this range sits within the range of the previous day. So you actually have a, you know, a combination, and that's really, you know, a phenomenal thing when you can get it, when you get a key reversal and a coil. And so basically you just put your buy stop above that, and now you're in this trade. So Daniel says, yes, Teladoc has an inside. Yeah, we looked at Teladoc. The reason why I did that trade was that it has an inside bar. Here's this little narrow range bar, you can see on the chart there. So I just put a sell stop right under the low of yesterday's low. I think the low yesterday, I don't know what it was 145.90 or something. So I put it slightly underneath the low and just let this, once it confirms, now it's on its way. Says earnings for Beyond are tomorrow. So, Beyond, to my mind, could be like a Peloton where, I think we look, sorry. So this is Peloton, and you can see it kind of had these waves where it went higher, and kind of Beyond Meat is doing this, where the big pattern. So you can see this is Peloton, where the major patterns told you all the way along that this thing was going to break lower. I've been saying this since, December, February. So here's a double top and a Head and Shoulders right there. So once it broke this neckline, that was your confirmation. Then it traded, then it put on another double top. Once it broke this neckline, it was another confirmation, yet another double top here. And then you had kind of this leaky key reverse, this descending triangle. It all started off with this key reversal right here and then you had earnings so earnings typically should shoot the market in the direction that it was previously indicated. And Beyond Meat looks very much the same way, where you have a bunch of bear price patterns. And now you have this inside bar, this narrow range bar. So basically I would put a sell stop here, into tomorrow's session. The low today was 196.25. And, it may or may not put you in there. And then, I would just be short going into earnings here. And, I expect that we could get, an apocalypse on the way down. Sun says, does the color of the key reversal matter? Not really. I just look as to whether prices close closer to the high than the low. Sometimes they can be, blue because they don't quite go through the previous day's close, but they still close on the low of the day. Here's a key reversal, but it closed on, it did close red. It doesn't matter. To me, it doesn't matter the color. It's to me, and this is why I use bar charts and not candles, because I can see very clearly market made a new high, close on the low on a huge range bar, made a new high, close on the low in that area. And I started getting short right in there. Here's a little inside bar. So the market turned, put a little inside day bar there. All you have to do is put a sell stop there and you're into, just a huge trade. So I use a combination of, so the first thing I say to myself, what is this thing doing? What is this doing? Is it an uptrend or a downtrend? This thing's been cut in half, over the last year. And I think it'll be cut in half again. So it's in a downtrend. Then we look for the patterns. Then we look for the insurance day bar. Then we look for a trade execution. And I do this over and over again. Sometimes you're right. Sometimes you're wrong. The idea is to tag these big moves. What is the take profit on Beyond? Probably $40 or lower. So you can see Beyond really for most of its history is in what I call a distribution, where the smart money really looks like it's been getting out. You can see all of this is distribution. And, now, this thing is just waiting to find its final resting place, which I think will be down here. this whole thing is just a big bear pattern sitting on a neckline here at about 113. Then you had the secondary support right around 100, and now you're, leaking underneath that. So to my mind, earnings should crater the stock. So by Thursday, we should see this thing a lot lower. Now I bought some put options, very far out of the money, and I could risk losing it all if the market, even if the market goes, from 98 to 90 and a half, drops $8, I could lose all of my money on those put options. Simon says, thank you for great content. You're welcome. All right, so yeah, I don't want to look at 100 different charts here. I really just want to impart to you how I look at setups. So I will finish by looking at gold. This was let's see. Instructed our members on Sunday to buy gold at 18.19. Where's gold right now? I'm making a few dollars on gold. So I got in on that trade at 18.19, and now it's 18.31, and I'm making $32,000. So it's trading at 18.31. I got it at 18.91 on a buy stop on Sunday night, based on the email that was sent out. And I was looking at this long-term pattern and then the key reversals. So sometimes the bars within the pattern start pointing which way this thing wants to break out. So for the last 6 months, ironically, I've been short gold. I've made a ton of money shorting gold. And you can see that gold is sitting on this huge support level within this ascending broadening price pattern. An ascending broadening price pattern is where the prices go higher through the pattern, starts life narrow, and then widens or broadens at the top. So it's called an ascending broadening price pattern. Now, all these patterns are neutral. They can go one way or another. Now, typically, this is a bear price pattern where things come out here and then they go that way. But in this case, there was a predominant amount of information that led me to believe that prices were going to, at least go up in the short term by virtue of these guys right here. You had a double bottom right there. And it was really the reversal action. Made a new low, close at the high, 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 made a new low, close at the high. So all of these are pointing in the direction that gold wants to go in. So this could be, a formidable inflection point, where we're sitting right on this support level. You've got all this thing, and this could be the start of a huge move in gold. I've been a little skeptical of the upside, but path of, just feels like you need to be long right now. So you can see we are sitting right on this huge resistance level. So now, we're going to see how the market responds to this resistance level. And so the next level is about 1900, then about 1950. So this is a critical level. There are two key reversals right there standing in the way of any progress. So I do think that, the market still has some legs to the upside here. And, we'll see where, what it does. But, again, I just said, put a buy stop there at 18.19 and let the market do all the work for you. So this is, again, where you don't have to sit in front of the screen. You observe your price action. This is a weekly chart. All I said was put a buy stop right there above the high of the weekly reversal bar and let the market do the work. And right now the market is going higher. And now you could, just put a stop loss behind this thing if it turns. And, now you're in this trade and just see where it goes. This thing could, who knows, go to 5,000 from here. Mark says, thank you for your generosity. I've learned so much. So you're welcome, Mark. So at the end of the week, I'll ask you guys for a review. If you'd be kind enough to leave one, that would be great. So I think I'm going to end it there. I wanted to talk about risk management. And again, just reinforce how I look at these patterns. This is the one trade that I'm looking at tomorrow. I'll leave you with this. I made a ton of money in Lyft in January. I think we looked at this. Yeah. So I looked at this double bottom all the way back at the beginning of the year, got in at 45, got out at about 60 and made a lot of money on that trade. So this is what I was looking at in Lyft at the beginning of the year, where I saw this double bottom here. And so this is kind of like, me, where I see this, the beginning of something. And then, like me, we hit this thing and, came off, but doesn't mean that, this thing's not going to go higher. So once I kind of felt like I understood what this thing was telling me, we had an area here where this thing kind of turned lower and I bought it right there. So once, it's like ME, it's like I'm buying into a bad looking day on the principle that, this is the operating, governing pattern here. So to me, Lyft looks like it's put in this bottom and now, it's got this triangle here, but you can see this formidable key reversal, made a new low, close on the high last week. Probably should have bought it, right there. But today is another good opportunity, I think, where Lyft is setting up. So once you understand the long-term thing, it looks like it's breaking out. Now, you have your inside day bar. So this is Lyft, and you're kind of in this channel here. And now, typically these channels, they can go one way or another. And so it looks like this thing wants to break out of this channel. So here is your inside day bar today. Literally rests within. So I'm going to comprise my email tonight to our members, and this is what I'm going to suggest. Put a buy stop in Lyft right here. The high was, high today was 56.30. So it closed right on the high. So you could, put a buy stop at 56.40, 45, 50, whatever you want. Put your stop loss here. You've got a $2 risk to make, who knows, 20. So once I kind of understand the long-term implication of that double bottom, then I kind of see how, this thing is building a base here. You've got this coil. And, let's see, sometimes you just put a toe in the water, put a 0.5% risk. And that's how I analyze, it doesn't matter. Lyft, gold, the euro yen, it's all the same to me. In fact, if you took this out, it'd be a lot better. This could be pork bellies. It could be natural gas. I would look at it the same way. So you can see that, markets should respond at certain levels. They, should resist. And then, if this was going to fail, it would have failed. But by not failing, it's going to go the other way. So if something's not going to go down, it's going to do that other thing. So you can see you've got this coil right at the top. You've got this huge, thing where you've got this energy. Then today you kind of just had this hangout day where you're building this energy, and I'm surmising the energy is going to uncork to the upside. And, so then I, put in an order to confirm that. So I'll put a resting order here, at 56, 45 or what have you. And tomorrow, if it opens and goes lower, and it's then no harm, no foul. So what I need is the market to confirm me. So sometimes, the market will open lower, and then, the resting order's there. I can go about my day. I don't have to watch all these charts all day long. If it goes down and then it clicks into me, I should just automatically be put in that trade. Sam says, trading is a game of probability. Trade small, but trade often. Well, I don't know about trading often. To my mind, really, it's about waiting for the market to come to you. Wait until you see a setup that you understand. So once I see the dynamics of this trade, where I understand the double bottom on the weekly, I understand this is in an uptrend, I understand that the bias is to the upside, I understand that I want to find places to buy it, then I wait for a day where it's coiling, and now I can understand exactly how to join this trade. How I can hop aboard this momentum and also understand my risk. And that's really what trading's about. I'm basically going to join the momentum here, and I understand where to put my risk. So this is my risk. And, once I understand the risk, then I let the market, how it's going to go, where it's going to go, what the time frame, how it's going. That's the unknowable. What is knowable is where to get in and what my risk is. Those two elements I know. And if I can get in a trade where I understand my risk, so I've effectively got a $2 risk for a $10 or $15 or $20 upside. I will do that every day and Sunday. Tomorrow I could lose on this trade. So what? I've lost $2. I'll move on. And so Janice says the daily chart is the best analysis for risk management. Yeah, well, I don't use 15-minute charts. So what I try and do is understand the long-term dimension. So I start off, looking at the weekly, whatever helps you understand what's going on that particular chart. So in this particular chart, I can kind of see this, double top, double bottom, inverted head and shoulders kind of thing, where I see the bottom. And so, this thing looks like it, wants to go higher. So this tells me really that this thing bottomed all the way here. But even though this thing, you can see that for months and months, it just did nothing. So sometimes trading is a waiting game. It's a patience game. You wait for your particular spot, and then let the market do its thing. I mean, we could be in for one of these now. Shaman says, why not buy it right at the bottom of the baseline? Well, because we're not talking about it, when it bottomed. We're talking about it right now, what to do right now if you're not in it. So, why didn't I buy it there? We're dealing with what we're dealing with now. And so all I'm saying is, based on what we're seeing on the daily and the weekly, that there is a good risk reward dynamic in the market in Lyft right now. And it doesn't matter if it's Lyft in the euro yen, corn, whatever your flavor of the month is. I look for the same principles. What is the trend? What is the pattern? Do I have an insurance day bar, key reversal, inside day bar? And then I layer it with an execution strategy that requires me to put a buy stop in a market I want to buy and a sell stop in a market I want to sell. So simply, I'd enter a buy stop over the high of today with Lyft, and let's see what happens. All right, guys, I'll see you back tomorrow, 4:30 Eastern Standard Time. So get a lot of messages here. Thank you. Tim, thank you. Alice is another great session. Thank you. All right, guys, thanks a ton. And I will see you back tomorrow at 4:30 Eastern Standard Time.
All right, Mark. See you tomorrow.
Thank you, Dwight.